Hi all, welcome to Free Float. I am Shiv and I have Kishan with me.
Hi, Sham.
Today, continuing with our discussion of different allocation and diversification options, we'll be discussing the so-called permanent portfolio. Last week, we discussed the 60-40 portfolio and highlighted why it may not work as advertised in the Indian context. Today, we'll be looking at the permanent portfolio. Kishan, do you want to start off introducing what the permanent portfolio is and what it's intended to do?
Yeah, so I think the permanent portfolio, is what you call an endowment portfolio. You know,
Okay.
uh, yeah. So the endowment portfolio is where you perhaps have an investment strategy, which is long term oriented, and you invest in you invest in asset classes, based on a predetermined uh, like allocation ratio, you know and the idea is that you're not investing this for a timeline, like fixed timeline, right? You have a long investment horizon, and that allows you to withstand short-term volatility. You also not withdrawing capital from the account, or if you're withdrawing capital, you're withdrawing capital at a fixed determined ratio. So every year how much of outflow as a percentage is going out, either to meet the portfolio expenses, or for the beneficiary of portfolio to to enjoy the fruits. But the idea is that you run a portfolio for a long period of time, and this is not few years. It's perhaps a few decades, even a few generations. And I think most investment portfolios uh, would like to be like this. If you if you ask anyone, whether you would like to invest for eternity, I think most people will say, yeah, because I think most people want to see their wealth passed on to their children. So, and if you're starting off at when you're 20, 30 years, and if you want your wealth to be passed on to your children, your lifetime and your children's lifetime is perhaps, 100 years, at least. So, if you're thinking about 100 years, that's pretty long period of time where no one in, on CNBC uh, has an investment horizon of more than 6 months. So in that sense, it's like eternity. Uh, but obviously, it's not for everyone. Not everyone wants. For them, their immediate goals of meeting the goals of retirement, or sending their kids out for for study, or for just saving up enough for a rainy day. I think those priorities are much more different than, say, somebody, say, a wealthy family who's looking a few generations out. So yeah, so I think for me, that's what I understand from the permanent portfolio, where you build a portfolio that can where you have a good risk taking ability, and with that risk taking ability comes, because of your risk long investment horizon, and because of the long investment horizon, you can invest in uh, asset classes which you normally a typical like RIA would recommend, such as private equity, uh, or mid cap stocks. Because in mid cap stocks, if you take the last 20 years, the risk premium for from investing in mid cap stocks, you've been rewarded with a much better return. But not everyone can withstand and that amount of volatility. But if you just if you have the stomach to invest uh, uh, to withstand a short term volatility, then it's something that people should look at. And I think the other thing that comes from investment portfolios, like just the source of diversification options that you have. Because you have a large portfolio, um, uh, uh, it's not possible for an average person to do it because the size of the portfolio is small. So, and every investment option has a minimum ticket size. While a large investor can buy, say forest land, or like timberland in like Australia, and then buy some cattle ranches in Texas, and buy some few large cap stocks in India and in China, and stuff, and all of that still might not be more than 35-40% of the portfolio, but it's diversified to an extent where none of those assets are even closely correlated, and I think that's another thing of when you talk about endowment or a permanent portfolio, those things come into play, which an ordinary investor just does not have the chance to do it.
Right. I think, from an ordinary investor's point of view, a permanent portfolio, the whole concept was introduced in a book, where the author suggested that, you just take four asset classes: equities, gold, cash or cash equivalent, and long-term bonds, and allocate equally between them. Right, so it's like 25% allocation to each of those four, and you're all set. So the thing is, like with every investment funda, it started off, I think, in the mid 80s, and by the early 90s, the whole strategy looked great on paper, right? Because bond yields were dropping, so that provided a great tailwind for the portfolio, and equities were also in a bull market in the US, so everything kind of worked out for that so-called retail version of the permanent portfolio. And surprisingly did great for US investors, even from a short-term point of view, right? So if you look at the 3-year rolling returns of a monthly rebalanced permanent portfolio, there never was a period in the US where such a portfolio gave you negative returns. It's always been positive, even in a 3-year time frame. So a lot of advisors, point to this and say, "Hey, this is a great idea." But the Indian experience has been quite disappointing, primarily because the portfolio allocates. When you think about it, the portfolio allocates 50%, of the assets to fixed income, right, to bonds. And Indian bonds, whether they're short term or long term, have been extremely volatile. So nowhere close to the stable, flight to safety asset that US bonds are. So we are extremely, our bonds are extremely volatile, and that has completely inverted the risk structure of this permanent portfolio. So the only thing I feel that makes sense is the investment towards gold. But somehow, putting 50% of your portfolio in fixed income in India, where, typically, we have allowed our inflation rates to, sort of get out of hand in the past. And even now, our inflation rate is higher than our short-term yields. So we are in a negative, negative real return setup. Yeah, and I don't see how this makes sense. Putting 50% in Indian bonds, I just don't get it. But I do appreciate the allocation to gold in this setup. And having said that, even in the US, right, given that 10-year yields are already negative and short-term rates are at zero, how much do you expect that 50% bond allocation to get you?
It's not. I would think that the investment theme, like throughout all of these things, right? Gold is an asset class which is probably something that you're investing as a hedge to your whole, to probably a bond portfolio to an extent, because as you said, right now, inflation being at above, above the I mean, the interest rates on bonds, inflation. I mean, gold makes sense as a hedge, and especially doing flight to safety. It's an additional source of hedge. So it's interesting that gold is part of this portfolio. But do you think a portfolio like this should have at least more like asset classes, maybe REIT, or something that's more uncorrelated, maybe even like the category of stocks. So you can have dividend yielding stocks, or uh, just to diversify your source of risk, that maybe you can have different allocations to defensives, and different allocations to growth, to make your portfolio more resilient. Do you think you should, like a permanent like portfolio should, have all those ingredients?
Right. Makes sense. When you think about diversification, I think most people stop at adding different asset classes and, stop looking under the hood, primarily because the ticket sizes are too low, right? So when you're a small ticket investor, you're better off focusing on the broad asset classes, so to speak. Because even REITs, right? In India, I think I think the lot size is 2 lakhs, right?
Yeah.
Yeah. Which I don't, um, you know, it's, I don't get why it's 2 lakhs. SEBI in its infinite wisdom, I guess. But, magic, right? So I agree with you. Because when you think about diversification, even within equities, you can't use a sledgehammer approach. You need a sort of scalpel approach. But at the same time, for a person who's just starting off, it might just feel like too much information and too much too much overload, right? So there are so many things you can't diversify into. Like you pointed out, you can't, like, I can't go and buy Australian farmland or whatever, right? Whatever that is. So it has to be sort of tailor-made for the investor's capacity, as well as his experience, right? So even if an HNI comes to you and says, set up an endowment portfolio for him, your first pitch cannot be go and buy Australian timberland, right? He's going to run. So a lot depends on the investor's comfort zone. So they can understand gold because it's something that their parents would have invested in, their grandparents would have invested. They can understand some bits and pieces of it, but there are some assets that are hard to grok, and so even though you may be convinced, right? You may have a great degree of conviction that it works. But if the client doesn't have the same conviction, then the first sign of trouble, and he's going to scoot and probably blame you for getting him into something that he did not understand. So it's always good to sort of tailor it to the individual. Especially the way I see it, right? You may be totally convinced that it happens at all levels, right? You take a stock like the most controversial stock is ITC, obviously. So let's not go there. Let's take Bosch, right?
Yeah.
Now, I would say that Bosch India is a typical value stock, right? It's in an almost hated industry. ICE engines are supposed to be on their way out. And Bosch is like a leading OEM for all ICE engines. One of the biggest things going on in India is the spark plug. So they're extremely levered. They have huge capex. It's the very epitome of old industry, right?
Right.
So nobody likes that stock, but when you speak to a client who wants to do value investing and you pitch this idea, the only thing that they can focus on is the negatives, right?
Yeah.
And if you force that person to buy it, uh, the minute the stock sort of starts sliding, it's like -5, -10, they're going to look at you and say, see, I told you, this is the
I know.
worst idea ever, get me out of the stock right now, so yeah.
And you cannot
So
say, it's and it's very hard to say, it's part of the strategy. You have like, more than one stock in your portfolio. You have to give the strategy. Some stocks would not work. But yeah, I mean, you're right. You can't explain yourself in that situation at that point, and it just adds to your stress.
yeah. Yep. So that's kind of the conundrum that I think all advisors face when it comes to advice on diversification and asset allocation, because there's always something that the client hates, and but it makes sense for that to be part of the portfolio. So it's a delicate balancing act. With that, I think we should wrap up this week's free float. I think next week we'll discuss something interesting. So we will deviate from this and just talk about how volatility plays a role in picking assets for their diversification benefit, and also how the frequency of rebalancing plays a role in overall portfolio returns. So it's a bit, quantitative rather than qualitative, but I think it's about time we took a leap into that. So with that, we will see you next week. Stay safe.
Right.